Unrivaled Nation, I did a video on Bros stock, Dutch Bros being the company. It's a coffee chain based on the West Coast, known for their fast service and fun concoctions, a lot of fun, very sugary beverages. I personally haven't been to a Dutch Bros yet. I do want to, though. It's on the bucket list. And I previously called out that broadly, I liked the company. It seemed quite interesting. It seemed like they had, a significant growth trajectory, but I didn't like the stock. And this was from the legacy video, and it's still on YouTube. I don't, delete my YouTube videos, so you can check that out from a few years ago. And look, I do make mistakes from time to time. It's important to call that out. Nobody is perfect. At least I haven't bumped into him or her yet. And, when you're dealing with imperfect people, you're going to make mistakes. That said, with Dutch Bros, I think I actually got it fairly right, where I said, hey, this stock does, over the next 5 years, I'm not really excited about the return. And keep in mind, this is from that video 2 years ago where I said it had about 50% downside, or maybe it was flat over 5 years. Maybe there was 100% upside, but it required tremendous execution. I didn't find it that compelling. And since then, this is actually a chart from when I made that video till now. And it's funny, for a brief period, people were like, Daniel, you're too conservative. The stock ripped 40% higher. And I got the usual, calls on YouTube of, what do you know, Daniel? And since then, it has lost about 50% of its value. And I think that's a super important lesson, which is that generally, if you're broadly right on the fundamentals, the stock price will broadly follow. And so it's arguably, don't focus on this. Don't focus on this volatility, because this volatility is what's going to cause you as an investor to go on the wrong path, the wrong journey, where you go, oh, look how I made 50% in a couple of weeks. You're missing the picture. You want to focus on the long-term fundamentals, because that's ultimately what's going to drive the price. And a lot of people get distracted with the noise of the change in valuation. And over a long time period, over a multi-year, multi-decade time period, the change in valuation usually doesn't add up to much, especially looking at like the indices. If you look at the S&P 500, change in valuation over a multi-decade period is effectively zero, in terms of the return contribution. So it's always about the fundamentals. And when I look at the fundamentals of Dutch Bros, I see a company, quarterly sales now reaching record levels, steadily marching higher. And this is broadly what I like to see. I like to see a company continuing to execute and see their operating margins has inflected from losses to profitability. And that was a concern that I previously called out, saying, wait a second, this is a coffee chain. This is a fast food sort of coffee chain, known for their drive-through and quick service and fun beverages. Like, this should be a profitable business. So I'm glad to see that the business has inflected to that new era of profitability, now around 10% operating margins, which you need to see in order to justify, the share price. So I like to see this. These charts and more are available completely for free for users at AI Ticker Chat. So you could check that out if you're interested under the fundamentals menu. Looking at Dutch Bros or Bros stock, so what's driving the business? And they talk about, look, we set a goal to reach 800 shops by the end of 2023, and it looks like they're going to nail that. And their goal is to expand by another 150 to 165 in 2024. So roughly that would pencil out to a 20% growth in their store base. So when you're thinking about the growth next year, you're thinking, okay, maybe around 20% growth plus the growth from their existing stores. So they do report company operated same shop sales and system-wide same shop sales, because they own, I believe, majority company operated stores is the majority of it, but they also have effectively some franchised, operations as well. And so, looking at this first quarter this year, started off a little bumpy, was down. Last year was flat. Folks don't like to see comp store sales figures that are, only 1%. You do want to see better growth than that. And so, it is possible, in addition to the 20% new stores, you could get same store sales, grow, another couple percent. So maybe you're talking around 20% plus growth. For those that aren't familiar, when you're talking about same store sales growth, you're talking about stores. Usually they remove the stores that are new. So you're looking at stores that have been open at least a year to get a perspective on what's that growth rate when you're looking at same store sales. So that's, it's a fairly common industry metric in quick service restaurants. So it does give you a perspective on this business model, and they are targeting about 4,000 shops over time with their drive-through convenience. That's a focus. And they also talk about contribution margins of 30% plus for shops that have been open 2+ years. So that does suggest an attractive return on investment where they can get, their capital back fairly quickly. 30% contribution margin, though, there's a lot of, give and takes that go into this. It's before depreciation and amortization expense. So I think realistically their margins are going to be a bit lower, but it does give you perspective of what they're thinking about and their strategy. This is historically a West Coast based chain focusing on drive-through and many lanes and quick service, no lobby. They are expanding this slightly. Now you have a walk-up window. It has become standard. The shops look a little fancier. They've gone from the older legacy model to now a more current configuration. And then they do view it as expanding a little bit. So you also see the size going from 500 square feet to 1,000 square feet. So that means you're going to be paying more in rent, likely. But still, you're not talking about a lobby. May have a lobby in some sort of future version, but no seating. So, whatever labor you have with the upkeep of, let's say, a Starbucks shop where you got to make sure that bathroom's clean because who knows what person's been in it before. And there's been a societal issue of like, hey, maybe we should just encourage homeless people to use our bathrooms. I don't get it. I mean, it's completely bananas to me. But so they're completely getting around that cost by saying, hey, yeah, we don't really have a lobby for people to come sit down in. This is a drive-through oriented fast service fun beverage business model. And with it, you would argue it should have even higher margins than Starbucks, I would think, just given this type of structure. Interesting to see the management here. There has been quite a bit of change in terms of management, which is usually some sort of red flag for me. But for me, I'm now looking at Dutch Bros thinking that they're using this to bring in sort of up-leveling their talent. They brought in a new CEO and president over the past year. Her prior experience was at Starbucks as well as at True Foods, where she was the CEO of True Foods. And then they're also bringing a new CFO, who previously was the CFO of Mod Pizza, and before that was a senior VP, I believe, of finance at Starbucks. So seeing these data points, normally it's important for me as an investor to size up management, to make sure, hey, are they going to take me potentially on a path that I don't like? Or are they not legitimate? Can I not trust them? And when I see this type of background, it does increase the trust factor a bit. And I do like to see that Trav Boersman, the co-founder, is still a participant in this company. He's still marketing it. He's still the executive chairman. And we'll talk about, his ownership stake in just a second. But broadly, when I look at this between Christine Barron's experience from True Food and Starbucks, as well as the incoming CFO, even though I don't like to see a CEO and a CFO turnover, it does suggest, given their backgrounds, that they're the real deal. That's an important data point. And arguably, they're bringing this in to say, hey, what can we do to make sure we keep up our growth? Looking at the sales, this is the part that I don't like to see, which is significant insider sales, millions of dollars from various different insiders, including one of the co-founders, Travis Boersman, who's been selling millions of dollars of stock along the way over the last few years. That said, based on his most recent filing, he's still the executive chairman and he still owns 3 million plus shares of stock, which is still worth quite a bit. So I do like to see that, but it's a fractional ownership position. It's not like he controls the stock with this type of position. It's it's a much smaller position. When I say control, I really mean unit economics. It's the vote might be different because he might have different Class A through D shares. But looking at it, it's 3 million shares off of something like 170 million plus shares. So it's not the huge ownership stake that I would like to see. So the question is, where does Dutch Bros stock go from here? First of all, in full disclosure, this is not financial advice. Also, a quick plug at Unrivaled Investing. My goal is to help investors by identifying companies with compelling long-term business prospects, attractive valuations, and aligned management teams. I'm looking for companies that I can partner with and hold for years with a prospect of hundreds of % upside. I share my investment journey in a weekly letter at unrivaledinvesting.com if you'd like to learn more. I also have educational investment videos. For example, if you want to think about how do you value stocks, like how I called out, Bros previously, check that out at unrivaledinvesting.com. So thinking about Dutch Bros, why is Dutch Bros taking market share? I think it comes down to a few key things. And I wanted to hear it sort of in management's own words. So I looked at the transcripts from the past year and asked this question: why is Bros taking market share? In which case now AI Ticker Chat then applies AI to look at management transcripts and says, okay, based on what management has said, here are the key aspects. And based on management's words, it's really a few things. One of which is the reason why they're taking share is partly because their goal is to expand. So they're saying, hey, we have an active goal to rapidly take share, growing from just a few stores a few years ago to 800 stores recently, with a goal to expand to 4,000 in the years ahead. Another key aspect is the party-like atmosphere, where they're making it a more fun brand, arguably, than Starbucks. Starbucks might be a fun place to get your homework done. This is a place where you're driving by and you're, getting this super fun beverage. And they also have fill-a-tray events and seasonal limited time offerings. It sounds like their marketing and their beverage game might just be a little bit better than Starbucks. That's at least what it seems like in terms of their promotional activity, creating excitement around the brand. They also have a rewards program that, creates a recurring, nature with their customers. Looking at the underlying financials, looking at the free cash flow in particular, this company doesn't generate it yet. Even though they're increasingly profitable, they're investing that in capital expenditures, which is opening new stores. And so they are still generating a loss in terms of free cash flow. So it is a cash burn. And one of the things I really don't like to see is that in the most recent quarter, they issued 300 million plus in stock. And the reason why I don't like that is, let me be super clear, is when I was calling out this video originally, it was a $55 stock, and then it ramped up 40% in a few weeks. That would have been the perfect time for Travis to say, hey, we are going to issue another couple $100 million in stock, so that way our balance sheet's nice and clean. And now with the stock 50% lower, that's a lot of additional dilution for shareholders. No, I'm not going to fault the incoming CFO for that. He had nothing to do with it. I'm not going to fault the CEO, who's only been here for a year, for that. So it's really the founder, who the chairman, and they clearly are bringing in other talent to run it. So it's just a data point worth considering, because this is the best capital allocators over time recognize when the stock is high, you issue stock, and when the stock is low, that's the time for buybacks. And when you see the exact opposite sort of behavior of like, okay, we issued stock high and then we're going to issue more lower, a lot lower, that isn't prudent, especially when it's being used to pay off your debt facilities. And that's what it was. They, of the 300 million raised, roughly 200 million went for debt repayment. So I'm just not, I don't like that. That is a sort of red mark against them. Thinking about the stock though, in the years ahead, look, they have grown at a very impressive clip, from a couple $100 million in revenue to around $1 billion expected for 2023. That's a hypothetical, guesstimate. Management, I think, said somewhere between 950 and a billion. So, my own guesstimate is right in that range. The question is, what does their margins shake out to be? They're currently around 10% margins. I'm assuming maybe 15 to 21% operating margins over time. That would factor in any sort of lease and finance interest expenses. So this might, we'll see. We'll see how this does. Oops. And then thinking about, what's the growth rate in the years ahead? Management, penciling out 4,000 stores, that would suggest, let's say 5x growth over time. So it would support, let's say 15 to 20% plus growth over time. So we'll see how they deliver on that. I look at this and I'm thinking, relative to where it was previously, this is much, much more reasonable. If they were achieving these margins now, it would be a 30 to 40, times earning stock for a company growing at 30%. So that is, I'd argue, much, much more reasonable looking at this framework. And keep in mind, stock price can go way higher, way lower. There's a hypothetical framework to think about this. And so looking at this, 30 to 40 times roughly, and then, maybe it grows 15 to 25% annualized over the next 5 years. We'll see. And so, this should say 5-year forward outlook, but thinking about it, applying some sort of multiple 5 years from now, I prefer to think about, cash yielding around 5%. I personally keep my cash at Interactive Brokers. You can see the link below. And, with that cash, it does make it harder to justify much higher hurdles or much higher PE multiples for stocks. And so that's why I'm assuming 5 years out at 20 to 30 times earnings multiple. But you could have a different take. You could definitely, play around with different figures. So based on this framework, I think the stock price is just much, much more compelling than it previously was. Now you're talking about something where if management executes, you have 100 to 200% upside. And if they don't, and it's sort of okay execution, then you're closer to break even over the next 5 years. And this is, in stark contrast with, how I previously penciled it out, where it's like, you have to have amazing execution just for okay upside. So I look at this and I'm thinking it's much more compelling now. I'd argue I'm more inclined to say I like the stock now. So if I had a, thumbs up, thumbs down, I would put a thumbs up on it, personally. I haven't pulled the trigger on Dutch Bros stock. I'm looking for things where, I like having a little bit more management ownership, where I believe management might be a little bit more astute with their capital allocation. And, but the framework in terms of that upside potential, I do like that, nearly 200% upside and, flat over the next 5 years if there's only weak execution. So that I think it's the share price coming down while the underlying fundamentals have sort of been backfilling. I think it's very possibly a good setup for Dutch Bros stock. If you have a different opinion, I'd love to hear it below, especially because, look, there aren't that many businesses that are like, yes, our plan is to grow by 5x over the next, X number of years. And that's what they're saying. They're saying 4,000 stores versus the 800 now. So having that roadmap, I do like to see. As always, if you're interested in learning more about the compelling ideas that I call out to my subscribers, check out unrivaledinvesting.com. Thanks so much for tuning in.